Ever wonder how startup founders seem to become billionaires overnight? Well, the answer usually comes down to one of two little acronyms: IPO or M&A. But here's the thing, these aren't some get-rich-quick schemes. They're actually the finish line of a marathon, the culmination of years, sometimes decades, of incredible work. They represent the ultimate endgame for startups and their investors. So to really get our heads around this, here's the game plan. First, we're going to define what an exit actually is. Then we'll explore the two main paths a startup can take. You've got the grueling IPO journey on one side and the strategic M&A handshake on the other. We'll even take a look at how the rules of the game are totally different around the world before we get to the big question: why does any of this really matter in the first place?
All right, so what exactly is a startup exit? Well, you got to understand, from the very second a venture capitalist puts money into a company, a clock starts ticking. An exit isn't just some ending, it's the main goal. It's the end game that pretty much shapes every single decision that startup is going to make.
But why? Why is this so incredibly important? It really all comes down to one word: liquidity. See, for early investors, founders, and even employees, almost all of their wealth is tied up in company stock that they can't just go out and sell. An exit is that magic moment that turns all that paper wealth into actual real cash. It lets investors pay back their own partners and, just as important, pour that money back into the next wave of great ideas.
Now, the most famous type of exit, the one everyone's heard of, is the initial public offering, or IPO. This is a massive moment. It's when a private company basically opens its doors to the public and starts selling its stock on the stock market. It's a huge signal of maturity and stability. It kind of says, hey world, we're ready for the big leagues and the scrutiny that comes with it.
But let me be clear, going public is no sprint. It's a full-on marathon. It's this grueling expedition that can test a company's endurance for years, sometimes even decades. It really is like climbing a massive mountain.
And I'm not kidding. The journey from a simple idea sketched on a napkin to ringing that opening bell on the New York Stock Exchange, that can take 15 to 20 years. It's an incredibly long, patient process of building, growing, and getting ready for that public stage. So this mountain climb is usually broken down into three super intensive stages. First, you've got years of internal planning and getting your house in order. Then comes the execution phase, where you bring in armies of bankers and lawyers to make sure every single number is perfect. And only after all of that do you get to the final stage, the realization, where the company actually goes public. You know, it's funny. Most of us only ever see that final roadshow where the execs are flying around, pitching their company to big investors. But that's just the tip of the iceberg. It's the final moment after months, sometimes years, of brutal preparation, financial audits, and getting grilled by regulators to prove you're ready for the spotlight. Okay, so not every startup decides to climb that IPO mountain. There's another huge exit path. If an IPO is like moving out and getting your own place, a merger or acquisition is more like a strategic handshake, where you decide to join a much bigger family. So in this scenario, a much larger company, what we call a strategic buyer, just buys the startup. Why would they do that? Well, it's a way to instantly get their hands on innovative technology, or a new customer base, or sometimes just the brilliant team that built the thing. It's basically a shortcut for big companies to innovate by just absorbing a smaller, faster one. But signing the deal? That's just the beginning. The biggest hurdles are almost always human. I mean, how do you merge a super fast, freewheeling startup culture with a slow, bureaucratic corporate one? How do you keep the star employees from leaving the second they get their payout? And how do you make sure customers stick around? Getting this stuff wrong is exactly why so many of these mergers end up failing. Now, this is where it gets really interesting, because the rules of this endgame change, like dramatically, depending on where in the world you're playing. The path to an exit in the United States, for example, looks really different from the path in India, and that reflects totally different ideas about how markets should work.
So just look at the US versus India, and you can see some really key differences in their whole philosophy. For instance, India demands that a bigger chunk of a company's shares, what's called the public float, is available for the public to buy. But what's really striking is that the US market has always been way more comfortable with companies going public, even if they're still losing money. They're betting on future growth. India, on the other hand, has traditionally set a much higher bar, wanting to see a strong financial track record first.
And the US market also has this really unique alternative called a SPAC. Basically, it's a blank check company. It's a shell that goes public first, raises a ton of cash from investors, and then it goes shopping for a private startup to merge with. It's kind of a way to sneak a company onto the public market through the back door.
And this comparison really shows you the appeal, right? A SPAC can be a shortcut to the public markets. It lets you bypass some of the really long, uncertain steps of a traditional IPO. It is a backdoor listing, but it's one that's come with its own fair share of controversy, and lately, a lot more attention from regulators. So, we've gone through the how, the processes, the rules, the regulations. But now, let's zoom all the way out to the why. What is the real, bottom line purpose of these incredibly complex events? And honestly, maybe the best way to think about it is with this quote. IPOs and M&As are first and foremost financing events. What does that mean? It means an exit isn't a finish line. It's more like a refueling station. It's a brand new beginning for the company's next big chapter. Whether it's a huge injection of cash from an IPO or suddenly having all the resources of a giant corporate parent, the goal is exactly the same: to get the fuel you need for that next chapter. It's the capital you need to scale up, to keep innovating, and to reach a level that was just impossible when you were a small, private company. And all of this leaves us with a really big question for the future. You see, for decades, the IPO was the undisputed peak of startup success. It was the ultimate prize. But now, with new options like SPACs getting popular and M&A becoming way more common, you have to ask, is that grueling mountain climb still the ultimate prize? Or are we starting to see new and maybe even better paths to the summit emerge?